Hey everybody, it's Terry Udy with the Udy team, Coldwell Banker, and we want to welcome you to our webinar. I'm here with my brother Keith, and we do have a couple of special presenters tonight. We're going to be talking about some very timely information, which is qualified mortgage guideline changes in 2014. So we want to welcome Jason Palliser and Kevin Shea with the Palliser Shea funding team. We're going to be hearing from Jason and Kevin here just a little bit later. They're going to be, again, giving us some great information on some of the changes that we're seeing in the mortgage industry. And this is very important whether you're looking for a house to buy or you're an investor. You need to know about these changes, not only if you're looking to obtain a mortgage yourself, but maybe thinking about how it's going to affect the real estate market on a whole. And that's really the main reason that we like to put on these webinars, is because we do like to give our clients and colleagues a chance to listen to us review this information. I think it's kind of a way to manage expectations as far as what's going to happen with the real estate market.
Knowledge is definitely power, and whenever you're talking about the changes in the mortgage market, I mean, it's going to affect the bottom line. These changes are going to affect how expensive mortgages are and how much money you're going to be paying over the course of a mortgage in order to get it paid off. So certainly good information, great stuff to think about. And just as we're getting started here, we'll do a little bit of housekeeping. We wanted to let everybody know that this presentation is being recorded, and we'll put it on a link and post it on YouTube. So if you're listening tonight and you can think of someone that might benefit hearing this presentation, then just feel free to go to YouTube, search under Udy Team, and you'll find this presentation along with a library of other presentations we've done in the past.
Real good. So now that we're into 2014, the year started off, and we're almost through January already. So a couple things that we're dealing with right now, particularly in the Midwest, is the weather is terrible.
The weather's awful. We got the polar vortex. It won't go away, but we're making our way past it, luckily, at this point. And then we're looking at the real estate market. Something that we do on the Udy team that we strive to do is always take a look at the market. Now, the market's been pretty good. In fact, the market's been up 18 months in a row.
18 months in a row where the market was up, and that's year over year. So compare 1 month to the next, we've been up 18 months in a row, which is actually pretty amazing. But what we saw at the very end of 2013 was we started to see a little bit of a slide.
A little bit of a slide, and now we're trying to figure out and pondering if this slide is going to continue into 2014.
And again, going back to the mortgage changes, is we really feel like these mortgage changes could have an effect. It's going to have some type of effect on the real estate market.
Certainly, and the timing too. And it looks like that the big servicing companies, the big banks, the government, et cetera, that they kind of had a plan all along, and that will become more evident as we get through some of this material. But they're releasing the new guidelines now that the market is doing a little bit better. They've held back on their foreclosure filings the last couple of years to try to protect the market. So some of the stuff that they're doing, might have worked and might make sense. Kind of makes you wish that they would have had a plan before the meltdown, but what can you say? I guess we're dealing with the aftermath still.
Correct. And it'll be really interesting to find out what Kevin and Jason think about these mortgage changes, and then also how it's going to be affecting the overall real estate market.
Absolutely. So we have some information here that we're going to go through. We're going to go real fast through our slides and just kind of touch on the market, kind of a snapshot of what the market's doing, particularly the foreclosures. We got this information from Realty Tract. And the information that you're looking at on the screen now, for the most part, is Missouri information. Missouri is a little bit, it can be a little bit touchy whenever you look at some of this information, because it's comprised of, two major markets, St. Louis and Kansas City. There are some other, decent-sized towns in Missouri, but there's a lot of rural and farm area in Missouri, too. So, we like to specifically touch on St. Louis because it's our home market, St. Louis and St. Charles, but taking a look at the Missouri numbers for us is very intriguing, and it's something that can help us and ultimately help our clients. So this first slide regarding the foreclosure discount, this is something that was interesting to us, and in looking at it, we're seeing that the foreclosure discount is going down. So basically, people that are now buying foreclosures versus non-foreclosed sales are not getting these as cheap as they were in the past. And what's causing this?
Owner-occupants.
More owner-occupants are buying, less inventory. I mean, we mentioned earlier that the servicing companies have, really slowed down over the past several years, the number of foreclosures that they're filing. And ultimately, I think that they did that to protect their own, breadbasket, so to speak. They didn't want to drop all these foreclosures on the market and continue to have the market plummet.
So moving right along, this is actually just some information that we have. Next slide, please. Jason, can you go to the next slide? Okay, here we go.
This is Missouri. This is just kind of a breakdown. Missouri, there's almost 6 million people that live in the state. Number of schools, median income is $46,000. So people in Missouri, compared to different parts of the country, don't ultimately make a lot of money. But you look down at the unemployment rate, 5.5%. That's pretty good.
Yeah, it's really good.
And then also the percentage of vacant homes that comes into play too. We do have a lot of people that come to our market in particular in St. Louis from all around the country, even all around the world, to buy real estate. And two factors that are bringing these people to our market. Number one is the affordability of the real estate. Real estate is very affordable here, even in St. Louis. And number two is the good job market. And this slide really hits that home. Moving on, like I say, we're going to go real fast through this information so we can hand it over to Jason and Kevin as soon as possible. Very interesting slide here, and this is the availability of the foreclosures. Now, as you look at this slide, what really stands out is that the foreclosures are, for the most part, under $200,000. So most of the inventory that's going to be hitting the market is going to be your less expensive homes, which ultimately is probably going to bode well for people that are thinking about picking property up and keeping it rented.
And obviously, this would probably be a little bit different if we were in a different state, maybe California or Florida, something like that. But in Missouri, you have to think that the majority of the homes are probably
more affordable
homes, Midwest.
Good point. The next slide is the number of properties per square foot. And again, you see that the majority of them are smaller homes, and it really ramps down until you get to the mansions. We thought that was interesting. Some of this might be people that bought more house than they could afford. Maybe jumbo loans, maybe ARMs that became due. I mean, in these big expensive homes. So again, for the most part, the foreclosures are going to be the smaller homes, the more affordable homes. But we did see a little bit of a difference here in this slide.
That's interesting, and it kind of reminds me of actually the neighborhood that we live in. There's a street that has enormous homes. I mean, we're talking some of these homes are 20,000 square feet, and there's probably 10 houses on that row on that street. And these people overbuilt during the boom so much that they couldn't afford the houses. Some of them were builders and they lost the houses, whatever the case is. But several of those homes, and we're talking $1 million, $2 million plus homes went to foreclosure just because people kind of realized that this is just too much house.
They couldn't afford it, or they just thought that they were so underwater on it that they had to walk away.
Exactly.
Very interesting. And then the next slide, number of properties per year built. This really shows that a lot of the foreclosure inventory, specifically in Missouri, is going to be the older homes. We've seen that all along. I mean, you've seen some builders go under. You've seen some new construction where there's been some foreclosures. The condo market has not been good. The condo market has been hit probably a little bit harder even than the single-family market. But, looking at this slide, it helps us to understand that, and the other ones that we looked at, that a lot of the inventory that's going to be coming that investors or people that are interested in buying a distressed house are going to be looking at are going to be the smaller, less expensive, older homes.
Right.
Which we have a lot of them here in St. Louis.
Right.
So good news and bad news. Foreclosure trends, and we're going to break this down by county. And this kind of goes back to the point that I made earlier about Missouri being comprised of just a couple major markets. But then we do have some rural, and we have the Ozarks. We have some lakes here in Missouri. So, as you look at this, Jackson County is Kansas City. They had one in almost a little bit over 1,000. And then you see Worth is a small county way up north, like a farming community. That one, along with the bottom, the Montano, or however you say that, those are probably anomalies for the most part. So we're keying in on Jackson County, which is Kansas City, Jefferson County, which is the county just south of St. Louis County and St. Louis County. This gives us a breakdown of the foreclosure status and distribution for Missouri. And what this really means in a nutshell, as you look at it, is that the amount of foreclosure sales have dramatically decreased. Down 60% are the auction sales.
Wow.
And in the bank-owned, what this bank-owned slide really means is that the banks are filing the trustee's deed. The properties are not going at auction, so they're not selling on the courthouse steps. And then the bank is coming in and filing the deed. Two different types of sales. And I have a lot of people ask me about that, about the difference between buying a foreclosure that's listed on MLS or buying a property at the courthouse steps. Very, very different how those two sales take place. And obviously, this is probably for a different webinar. But it's something that if anybody ever wants to talk to us about, we'd love to sit down and talk to you about. Point is that we do have a significant increase in the number of bank-owned homes being sold, and we have a 60% decrease. I meant decrease. 60% decrease of people buying these homes off the courthouse.
That's amazing.
And it really is. And next slide is the same information, just a little bit different, graph that you're looking at on the side. Where you see that the number of sales really year to year has really gone down so much. Very interesting to us.
One thing that I noticed when I'm looking at this graph is if you look at November 2013 through December 2013, I mean look at that dramatic decrease in auction properties. I mean that's a big slide. There's no doubt about it, and that might be something that maybe slowed down the housing market a little bit too. Just what we touched on earlier, just limited inventory.
Right. It was done with a purpose. And all in all, it did help the real estate market on a whole. So it looked like there was some planning, that they, as far as the timing and how this all unfolded. Okay, the next slide is foreclosure activity for Missouri, and this is, again, we're looking at Missouri, but if we go to the next slide, the geographical comparison for Missouri compared to the nation, it looks pretty good.
It does.
Yeah. So I mean, we're experiencing less foreclosures here in Missouri. Being in the middle of the country, we didn't see the ups and downs as much, even during the market highs and lows and the crash. And we feel that if someone has dollars and they want to invest in real estate, we think that St. Louis is a great market for it. We have people that are coming from out of state to spend their money here. The affordability is good. The job market's good. The fact that we're right in the middle of the country is good. We lead in medical. We lead in logistics here in St. Louis. So a lot of the stuff that we can talk about is great news. It's obviously not all good news, but there's a lot of good coming out of the market now.
It's interesting that you say that, because I read an article last week, and they actually talked about, believe it or not, I thought this was a term that we wouldn't hear for years and years and years. They talk about a real estate bubble in Southern California.
Right.
Already.
Unbelievable.
Yeah. So I mean, like you said, we don't experience the highs and lows like some of the other markets do, particularly on the coasts. But if you're looking for a stable place to invest, which I think a lot of investors are, I mean, and you put your money into real estate, St. Louis area, Missouri, is probably going to be a good bet for you.
Absolutely. And that's about all we have at this point. We're going to turn the presentation over to Kevin and Jason. We've known Jason for what, 15 years?
Yeah, too long.
Long time. We've been doing business with him for forever, it seems like. He's real well versed when it comes to banking. Between him and Kevin, they have over 30 years of lending experience. They're trainers, investment specialists, 2,000 closings. That's pretty impressive. Predominantly investors. They fund in all 50 states, and they really work to put together plans specific to their clients. So without further ado, we'll go ahead and turn the presentation over to Jason and Kevin.
Appreciate it, guys. Glad everybody's here to learn, and couldn't agree more with what Terry and Keith were saying. When you're developing a plan on where you want to invest, you want to find properties that are affordable, and you also want to find a good area that can cash flow well, which year over year we can in St. Louis, and also one that doesn't, as they alluded to, doesn't experience those highs and lows. So everybody in this training call, the things that we're going to go through from a guideline perspective pretty much covers the entire United States. But when you're developing your plan, just realize that we're global in today's market. So with the advent of the internet and all the tools that you have available to you now, the people who really win are the ones that evaluate and pick the right market. There's several markets in the U.S. Obviously, St. Louis is near and dear to all of us on this training tonight. And so when you're making those good decisions, just make sure that you're working with people that know what they're doing. And from our standpoint tonight, they're handing it over to us so that we can talk to you about what's going on in the lending side of things, not only for owner-occupied people who might buy a house from you, or if you lease a house and then later on somebody wants to buy it from you, but then also what can you do as an investor from a funding standpoint when you're trying to grow your portfolio, whether it's to buy a bunch of rentals and or flip, or do a little bit of both, and then sprinkle in some lease options here and there. So we're going to try and touch upon that tonight with our training. And again, I have Kevin with me here too, so we're just going to go through some hot topics and some things that you may want to take a bunch of notes on, and then when we're done, if Keith, Terry, if there's any questions when we're done, then obviously you can hit us with those as well, but we're just going to jump right in. So a few things to make sure that you're successful as an investor and to move forward and put your best real estate foot forward is we need to help you understand what the guidelines are, because that is well over half the battle. If you know what the guidelines are and what you can and can't do, then that's going to help you write good contracts, which from Keith and Terry's standpoint as investment specialty realtors, they love working with investors who have knowledge like this, because they know when you write a contract that it's a good contract and it's one that will close, because you know on the backside, the funding piece, last time I checked, nobody closes deals without funding, so that's why this is so important. So we want to lay a blueprint for you, again, to put your best real estate foot forward. Myself and Kevin, we always say you have to know the rules before you write the contract. Can't tell you how many times, and I know that they would never admit it, but Keith and Terry would tell you, one of the things that drives us crazy, because we're trying to help you get to the finish line and have some financial freedom through real estate, is when you write a contract because you're excited and you think you have a deal and you simply just don't know the rules, and no one's mad at you about it, but if you knew the rules before, then it would have been a better contract that we know that we could take to the finish line. So you just need to know the rules before you write the contract, which is what we're going to look to solve tonight. We're also going to talk about just presenting the perfect package. If you're prepared and you're taking good notes on this training, or if you're watching it later on YouTube, when somebody's referred you there to get some training, if you're prepared, then you're going to pass your competition, and ourselves as lenders and realtors are going to want to work with you, which is what we're going to try and do tonight from a funding standpoint. We're also going to talk to you about some things that you need to think about when you're evaluating the property. So when you work hand in hand with a good realtor that can write a good, strong contract, like the UD team, if you also know what we look at from a lending perspective, and also Keith and Terry's perspective here as the realtors, if we're all on the same page, that means we're evaluating properties correctly in the right way. And again, those are the deals that get to the closing table, because you can move faster than your competition. As I've alluded to, working with good agents. I'd venture to say that we've probably had over 500 closings together, the UD team and the Palliser and Shea funding team. We know from an investment perspective deals that are going to work and deals that don't. Now, candidly, if you take even just half of the notes that we're going to go over tonight in the bullet points that we do, you're going to be 10 steps ahead of your competition. Know the different types of funding. We're going to touch a little bit upon that as well, because deals change, and as deals change, your funding options change. So we're going to talk to you about those. And then the ultimate is, as we go through this training, we want you to take good notes and put these in as best practices for your investing business, and then we know our end result on the back end, after getting some good training on the funding side, that you can write some contracts with confidence. So let's talk about the guidelines trumping everything. So to get the best deal done, you need to do it with writing contracts that are consistent with the number of units that you're doing. Time and time again, we know that investors will write, and we're going to touch upon these, an investor will write a contract on a single family, two family, or four family, but they don't know that there's differences from the funding perspective, the amount you got to put down, your interest rates, and then all of a sudden when you're in your contract period, you find some things out that you didn't know, and all of a sudden it turns into something a deal that you can't do. So we want to safeguard you against that. You can be the perfect borrower, but with the incorrect contract written, you don't get a deal. So we're going to touch upon that a little bit. Fast closings with incorrect seasoning equal no deal. So you may buy a property, somebody may want that property, and it seems like a dream come true, but guidelines are going to hold that deal up and ultimately maybe make your buyer of your property go somewhere else. So we need to talk about that. Good cash to close with incorrect assets. You may have plenty of assets, but if they're presented incorrectly to the lender, it equals no deal. You may have some good cash flow, but you don't have the correct documents, and again, takes us to a point to where we can't get your deal approved. So we want to try and bulletproof you against that and lay a blueprint for you. And then when you sprinkle in the new guideline changes, as long as we're on top of them, the bottom line is that the most informed investors are going to win, period. So having said that, laying our foundation for tonight's training, let's just start to jump in and talk about qualified mortgages. So there's been some recent changes. You've probably seen it if you're an investor or starting to get into investing, and if you've been reading online. There's been some changes talking about qualified mortgages, and then more importantly, what loans will get done by a lender and then bought up by the big Fannie, Freddie, VA, FHA, you name it. We have to understand what changes have happened as far as qualified mortgages go. So one of the biggest changes, and if you're taking notes, this applies to yourself. And just remember on tonight's training, it also applies to people that are buying property from you, whether it's a lease to own where you get them to buy down the road, or whether you've fixed up a house and you're looking for your next deal and you really want to write the next contract, but you got to get this house sold first. So under the qualified mortgage changes for 2014, we need to talk about the debt ratio a little bit. Also, too, we need to make sure that you ask your buyer what type of loan they're looking to get to buy your home, because that's going to make a difference. And then total cost restrictions on the loan. So the qualified mortgages, these are some of the changes that affect some of the bullet points that we just put on there. So interest only versus negative amortization. Some of those loans are what we consider now not qualified, and the big places won't buy them. So what happens is all the other lenders that you probably speak to, whatever city you live in, they're going to shy away from those type of deals, whereas before they can make it, Fannie, Freddie, FHA, VA can make a decision to buy those because there weren't these guidelines in place. So we're going to strip those things down and break those down so that you move forward, again, with your best investor foot. So we'll talk about first the stricter debt ratio. So what the qualified mortgage changes is, changes that happened for 2014, all these changes have stated that whereas before there was a lot of wiggle room and a bank or Fannie or Freddie on the back end, when a bank funds a loan, would actually buy that loan. What I want you to understand is that local banks and brokers, they fund loans, whether they fund them in-house or they broker it out, it doesn't matter. Ultimately, whoever does that loan, they need to know that it can flow upstream to the big places, such as the Fannies and the Freddies, FHA and VA. If they can't unload those to free up their money to give new people loans, a borrower that wants to buy your house loans, then all of a sudden lending stops. So one of the stricter things that's happened is debt ratio guidelines have changed. So now if all of a sudden your debt ratio is over 43%, it's going to be monumentally difficult to get that loan approved. Kevin, I know you're on too. Do you want to expand upon that a little bit?
Yeah, I can expect. Ooh, I got some feedback. Basically, this all came into effect on January 10th.
Hey, Kevin, you got.
Can you hear?
Go ahead.
And basically, we used to go up for FHA up to 56% debt income ratio. They dropped that dramatically, which overnight took a lot of people out of the market for the houses, the type of houses they want to buy. All of a sudden, somebody might have been qualified for a $150,000 house, and now they're going to have to change their whole criteria in order and probably lower house of what they can buy or what they want to buy in order just to qualify for the new mortgage loans.
Okay, so thanks, Kevin. So what Kevin said was before, Kevin, if you want to mute yourself. So what Kevin's alluding to is that where before we had wiggle room, we could run an approval and get approvals for you to get a property or for somebody to buy a house from you, and we could go all the way up to 50, 55, 56 debt ratio when we run an automated approval, which is basically what everybody does in today's world. Now it's a pretty strict cutoff at 43%. And so you need to be aware of that. And so if you're putting your good investor hat on for yourself and also for the people that may be buying your homes that you do this calendar year and moving forward, you need to have a debt ratio of 43% or less. The next bullet point on here is banker versus broker. So the qualified mortgage rules that changed, you need to understand, are you working with a banker versus a broker? And here's why this is important. In today's world with the new changes, a broker, there are stricter guidelines on cost, which may make your deals and you and your buyer not doable anymore, and I'll get into that in a second, where bankers have a little bit more flexibility. So I'm going to give you a second before I move on this. I want you to understand and write this down. Brokers have stricter guidelines as far as the cost structure goes, and bankers have a little bit more flexibility with these changes. So you really need to ask that question. Ask if they're a banker or a broker. It's very, 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 very important. So write that down and give yourself plenty of space. I'm going to give you about 10 or 15 seconds on that, and because I want to go over a few things that are different here. So write those down really quickly. Okay, so let's dig into broker. In today's world, the guideline changes. There can only be a certain amount of percent in cost, and so really where the jeopardy lies in is in some of your smaller deals. So if you're looking to sell to somebody, and obviously there's costs involved, there's going to be an appraisal, title work, you name it, recording of the deed, loan origination, underwriting fee, whatever it may be, brokers in today's world are very restricted. And quite frankly, I mean, I've been doing this 20 years. I like being a broker. I've been both. I'm a banker now. And the reason that's important is that you may have a deal, and just because the costs are normal, if it's a smaller deal, that's a higher percentage cost of your total deal. So if underwriting is $300 on a file and appraisal is $300 on average, $350, whatever it is, but it's a smaller purchase, well, that overall cost doesn't change if it's a the cost of an appraisal doesn't change if it's $200,000 purchase versus 50, but where it does change is that there can only be so much in cost. So therefore, it becomes vitally important to understand that if you're working with a broker, that they may not be able to fund that deal and get it to the finish line for you, or the person buying your property. And so one big note you want to take as far as protecting yourself goes is ask the question. Now, whether it's your funding or not, somebody's going to buy from you. If you're going to do multiple deals in your real estate career, you're going to sell to other people. Ask them or ask the agent, say it's very important to you to find out if they're working with a broker or not. And if you want to make a special note, especially when it's a smaller purchase price, because there can only be roughly 3% in total cost, and that makes it very difficult to get the deal done. Having said that, on the banking side with the new mortgage changes, the bankers still have leeway. So certain things that are deemed as part of the total overall cost from a banker's perspective are not. So they have more flexibility on that to structure your deals right to get all your deals done. So hopefully that makes sense for you. So the big takeaway is that once you go over 3% in total cost, it starts to get a little rough. And then from the banker perspective, we have a little bit more leeway as far as that stuff goes, and therefore those smaller deals become possible. We've seen it time and time again. Keith and Terry can tell you the same thing. We've seen it no less than 1,000 times over. And very, very big deal with the changes that have taken place. Deal size, and are you working with a banker versus a broker, where in the past it really didn't make as much of a difference, but with these new guideline changes under the qualified mortgage rules, it's going to make a big, big deal going forward. And I guarantee you, if you're not prepared this calendar year, you're going to run into that, and it's going to cause you to miss out on another deal, and then obviously that takes money out of your pocket. Kevin, do you have anything to add onto that, or should we move on?
No, we can move on. That sounded great.
Okay, sounds good. So now let's talk about some other things that hurt people. So less than 10% equity, they have PMI, and it never drops off on an FHA loan. So let's talk about somebody having equity or selling points for you on a property. And then if you have more than 10% equity, PMI can drop off at 78% loan to value, or after 11 years, whichever comes first. This is important. This is important for you to equip yourself as an investor as a selling point. So let them know, hey, if you're buying a property and you're giving them a good enough deal, or if you can find some creative ways, or they have enough money to put down, and you're an informed investor, say, hey, look, if we could find a way to make sure that you have 10% equity, then all of a sudden your property becomes cheaper because the PMI can drop off. And where other people, if they're trying to qualify for your property, especially if you're working in the first-time home buyer market, if they have less than 10% equity, that PMI is never going to drop off. And that's something that's good to know when you're talking to potential buyers and be like, look, we're going to structure this in a way to where we can try and get you to maximize your equity so that we can have your payments drop even more. So that's a strong selling point for you. Now let's talk about some more hardcore investor items here, and some what we call, Kevin and I call non-negotiables. So when you're trying to flip a property, so we're talking about a property being flipped to you, or if you have a property and you're going to sell it and somebody wants to buy it from you on a conventional loan or FHA, or you're selling it to another investor, what type of funding do they have? So we want to break this down so you have a good blueprint. So flips, the real question here is, who are you going to flip it to? That's the big question. And we're talking about whether your deal dies or goes through or not. So this is super important. So let's talk about if you're going to flip a property conventionally. So if you have a property, whether it needs a bunch of work or not very much work at all, and you're going to turn around and try and sell it, typically if the person buying it from you, or maybe you're buying it from somebody else who's flipping it and you're getting conventional financing, for you to get your loan approved, it's usually about 30 days. So if you're flipping or you're getting conventional financing on a house that's being flipped, as long as you own it for 30 days or more, typically you can get that deal done. If everything's lined up perfect and you're less than 30 days, you could run into problems. Where most of you are going to fall is that
Jason, can I say something about that real quick?
Yeah, go ahead.
On the 30-day note on the conventional financing, it's from the date the deed is recorded. It's not from the actual date that you purchased the house, that you actually sign the papers. It's 30 days from the date that the deed is recorded with the county that you live in. So that's an important thing to know, I think.
Good point, Kevin. So go ahead and mute yourself. So what he's simply saying is that, let's say you bought a house on January 1st, and it takes 4 weeks to get your deed recorded. And 45 days from now, you're like, well, I'm well over my 30 days of owning the property, but it was recorded 30 days later. You still have 2 weeks, even if they want to close on day 45 or day 50. You're going to have a very difficult time getting a bank to approve that loan. They may make you withdraw the loan and start all over. So that's something that's very important to you, is that you have to, the deed, good point, Kevin. The deed has to have been recorded for at least 30 days. If somebody wants to buy from you conventionally or somebody wants to flip it to you, they better have been on the deed for at least 30 days before you buy it. Otherwise, you could run into to problems and the deal falls apart. On the next bullet point, that's where most of us are going to fall into when you're selling a property. You're probably going to sell it to somebody FHA. And so if you're going to sell at FHA, there's a few rules that we want you to be keenly aware of, taking notes here. There's a 90-day rule. So they want to see that you've owned it for at least 90 days before you flip it to somebody FHA. But if you buy a property that only needs 2 weeks worth of work and you're in a market where the house sells in less than 60 days, you're probably going to find a buyer who's ready to roll in less than the 90-day marker. So some things that are good to know so that at least you're equipped moving forward and you can budget correctly are that they like to see that you've seasoned it or been on title for 90 days, but you can still waive that 90-day rule with a second appraisal. But here's the kicker typically. So again, this is one of the big things you need to take a note on. No one's telling you that you can't find a buyer that wants to buy from you FHA in less than 90 days. No one can tell you that, and you can do it. But what you need to understand is that most lenders, I would venture to say, if I'm being presumptuous, even 99% of them will require a second appraisal, and they will not allow your buyer to pay for that second appraisal. They can pay for the first one like a normal loan approval, but that second one has to be paid for by you, the investor. And on FHA, typically you're going to have on a FHA appraisal, you're going to be anywhere from $375 to $475. So you need to make sure that you're aware of that. I also want you to know that so you don't so your deal doesn't fall apart because all of a sudden you're mad because somebody's telling you to pay for an appraisal and no one's ever asked you on the selling side to ever do that before. So how do you get around the 90-day flipping rule for FHA? Just realize you can get a second appraisal and it can close in 30 days or 60 days. But typically you are going to have to pay for that second appraisal as an investor. So that's neither good or bad. As long as you know going in and you plan for it and you're ready for it and you budget for it, then you can close your deals faster and move on, make your money on that deal and move on to the next deal and write a strong contract. So the next thing about flipping and who are you flipping it to is if you're going to flip a property to an investor. So as I stated before, if it's conventional, you need to be on the deed. The deed has to be recorded for at least 30 days. So now you know if you're going to sell it to somebody and they're interested within a week of the property that you're looking to flip, you're fine with that. They're fine with it, but you need to ask them, hey, what type of financing are you getting? Are you paying cash for it? What are you doing? If they say, I'm going to get conventional financing, you now know that you need to be on the deed for 30 days. Otherwise, that deal is going to fall apart. And they may not know that, so you need to know that going in. And then secondly, if you're flipping to another investor, it's a really good deal. Then if you get a hard money lender, typically will not have any seasoning rules. If it's good, they just look at it, what's the value of the property, what are they buying it from you for, and if they've got hard money lined up on that property, then there's no seasoning rules, and you can flip it right away. Now talking about that, let's talk about your funds for closing or for somebody who's buying your property. So here's what I want you to understand. Funds to buy a property need to be seasoned for 60 days, and whereas before in the past it was no big deal, now it becomes supremely difficult and a lot more difficult for a bank to give you a loan approval if you're trying to use your business accounts. So what does that mean? Where do we like to see your down payment funds for property? In a personal checking account, personal savings, personal money market, stock, CDs, and if you're using the stock and CDs, you're going to want to show proof that you liquidated it. But your business accounts, whereas before it was easier, a lot of banks won't accept your business funds as seasoned money towards down payment. Here's why. They don't know if it costs $1 or 30 grand a month to run your business. So therefore, when you have a bank account with $32,000 in it and all you needed was $18,000 to close the deal, they don't know if you taking that $18,000 out of your business funds is going to hurt the economic viability of your company. And most banks in today's world say, you know what, we're just going to err on the side of caution and we're going to hold that loan up until you show us down payment funds that are from some sort of personal account. So just be aware of that. Those are things that have changed with most banks that sometimes hold an investor up. Seasoning, or how long, which equals how long have you owned something or had money in your own account, is a big deal when it comes to funding deals. Now, if somebody's going to buy from you, FHA, just realize they only need 3.5% down, and those funds can be a gift. It can be a gift from their employer, a gift from a family member, or a gift from a friend. As long as they show proof that they had the money to give, that person can buy from you. But if you're looking to buy a property, you better have your funds for down payment seasoned for 60 days. Then on the investing side of things, your reserve funds. So your reserve funds equal all the above, personal checking, savings, money market, stock, CDs, but also IRAs and 401ks. Reserves are this. Since you don't live in a property, and we're talking about buying an investment property, the banks want to see that you have reserve funds in place of the house payment. And so it's usually 6 months reserves. So if you're buying a house and the payment's going to be $500, they want to see $3,000 in a personal checking, saving, money market, stock, CD, mutual funds, IRA, 401k. They want to see reserve funds just in case somebody moves out or it takes you an extra month to rent it. Those are the investor rules. So you just need to know and understand that. And again, business funds are where people may shoot themselves in the foot. So we're talking about flipping, who you flip it to, what are the rules, what you should be prepared for, such as on an FHA paying for a second appraisal, flipping to an investor, or getting conventional financing to buy from somebody flipping, and then what do you need to groom yourself to look like in your bank accounts to make sure that the deal goes through. And as long as you know that now, I mean, you can write a contract today and close in 45 days, and as long as you have enough money in there that's seasoned and they can take an average daily balance, then you're good to go. So don't fall into that trap by not having enough money seasoned for down payment and also reserves. Now let's talk about closing and in what name. I will tell you this from a lending perspective, and Kevin could echo it as well, is that this is one of the ones that drives us the most crazy and causes problems down the road. And again, without you getting proper training, that's why we commend you for being on this training or watching it later on a replay on YouTube, is that informed investors write the right contracts, they close the right way, and they, quite frankly, win deals and win the relationships. And one of the big ones is, how are you closing on deals? There's basically three options. You can close in your personal name, you can close in an LLC, or you can close in a corporation name. Depending on what you're doing, you could do one of them or any one of the three, and none of us will raise an eyebrow, and it really doesn't make a difference. But where it does, where it really becomes very important is, what are your intentions once you buy the property? So let's dissect that and break that down so you never make these mistakes. So when do we want you to close in a personal name? The answer is this. If you want to refinance later, pull cash out, or you need to pay off a hard money loan, and you want to get the good financing with the best interest rates, 30-year fixed, then you're going to want to close on the deal in your personal name. And here's why. Lenders in today's market, if you've closed in a corporation or LLC name, but then you want to get regular 30-year fixed financing, you have to have it back in your personal name for them to close on it to get the good 30-year fixed financing at incredible interest rates. And what most banks are going to make you do is quit claim that property back in, if you did it in your LLC or corporation name, quit claim it back into your personal name and make you season it or wait 6 months before you can refi, which is what we don't want to happen. So if you know that later on after you get the property there's going to be equity in it, and you want to refinance it later, and you want to pull cash out, or you need to pay off a hard money loan because there's a start and end date on it, then do yourself a favor and close in your personal name. If you want to close in an LLC name, why do people do that? They do it for more protection. Or if they don't have any need to refinance, then you may want to explore closing in your LLC name. And then lastly, corporation name. For people closing a corporation name for easier commercial lending, because maybe you want to do some commercial lending, won't be a 30-year fixed. But what you need to understand is, if you want to refinance later to better rates on a 30-year fix and it's in your corporation name, then you may have to retitle it back in your personal name and season it for 12 months. We have a broker here in town that has to put it back in their personal name for 12 months because it was in a corporation name. So that's something that you need to know or understand. Kevin, do you want to expand on that a little bit or have any input on this?
I'd just like to say that an S corp is different than a C corp. S corp is more like an LLC, so I don't want anybody to mix up the two. S corp, you can quit claim out if you needed to and refinance right away. Whereas a C corp, you have the 12-month season issue.
Okay, so sounds good. So hopefully everybody understands that. There's pros and cons to each. The rule of thumb is if you need to refinance or you want the best interest rates or you want to pull cash out or pay off a hard money loan, then simply close in your personal name. And then after you close, you can always file a quick claim to put it in an LLC or whatever. And you can do that and then give yourself a little bit better protection on the backside. If there's no need to refinance, you're paying cash, doing whatever, or if you have private funds, then go ahead and close in your LLC name. And then again, corporation names makes it a little bit easier for commercial lending. And then also too, if it is in a corporation name, it doesn't show up typically on your regular credit report. If you get a commercial loan on it and it's in a corporation name, or even if it does, we can treat it as not a property that goes towards your total number of properties you can finance. So let's talk now about what some of the changes and what credit scores get you what on owner-occupied versus non-owner-occupied. So here's what you need to know. If you're trying to get a conventional loan or somebody's trying to buy from you owner-occupied, they need to have a 620. So the faster you can figure out what their credit score is the faster that you can try and figure out what you may suggest to them to try and get the deal closed. On FHA, you can go anywhere from 580 to 620, depending on what the borrower looks like. And so again, FHA is a little bit more lenient. VA is typically around a 620. And then USDA. So write this note down. If you can find properties that are in an area to where people can get a USDA approval, there's no real credit score requirement. Now, lenders that lend and do USDA lending may have what we call their own bank overlay, which means that, yes, technically there isn't a score requirement, but they may still have a, you know what, we still need a minimum score of 600 before we'll consider any USDA loan. If you're taking notes, I would talk to Keith and Terry if you're looking to invest in the St. Louis area and ask them every single time as a checklist, hey, is this property in a is this property considered USDA? Here's why. Because on USDA you can get 100% financing. So your buyers can get 100% financing. It makes it a lot easier to lease option a property if it's USDA approved. So that's just something that we're just trying to teach you here. There's no score requirement, but banks still may have a minimum score. And the sex appeal is that it's 100% financing. It makes a deal easier on the back end. Now, as a non-owner occupied person, here are some rules. If it's a single family, you need a 660 score and less than 4 properties financed. So if it's a single family residence, you can go down to a 660 with less than 4 properties financed and get your deal done. If it's a single family, depending on how many property you have financed, a 720, then if you've got 4 properties financed, you're going for deal number 5 through 10, it becomes tougher from a credit score perspective. So those of you who fall into that category, you need to realize that and see where your score's at. And just realize the lenders that you work with can tell you some things to raise your credit score. Again, like Keith and Terry alluded to later, we could talk on a different training on credit scores if everybody was interested. But if you have 4 properties or more financed and you want to get the best financing, you got to have a 720 score. If you have a 2-unit, 3-unit, or 4-unit property, you need a 660 higher or higher. And what you need to know is on 2 multi-units, the interest rate's higher. I would typically tell you to, if you're seeing if this property is going to cash flow and you're talking to Keith and Terry about a multi-unit, whatever the prevailing rates are for investment property, just add a 0.5% to the interest rate and see if it still cash flows. Because there's investor pricing hits, the banks consider it more risk. The more units means more people that have the potential to be unhappy and can kick holes in your wall, so therefore tougher guidelines and higher interest rates. And as I alluded to earlier, a tip is to work with a lender that has access to credit boosters. We can run a report and tell you, pay this credit card down $150, and through the credit scoring agencies, it'll raise on average your scores another 18 points. So if you're on the bubble, work with a lender that has access to do that and come back and tell you exactly what to do so that we can do a rapid rescore and get you to where you need to be. So let's talk about owner and non-owner occupied again. How much money do you have to put down? What loan to value can we go to? If somebody's going to buy a home from you, just realize on FHA they can go up to 96.5% financing typically, and some of those restrictions for those new guideline changes for qualified mortgages, on FHA you can still go up to 6% seller concessions, and they don't have to season their down payment money and gift funds from their work, which some of you have probably already taken a note on that. Most people didn't know that. That they can get down payment funds as a gift from their work, friend, or family member. And so FHA is probably the easiest path. But remember, if you're selling it fast, you may have to pay for a second appraisal. Conventional is 5% down and 3% seller concessions and no gifts. So that first 5% down, there can't be any gifts. So that makes it a little bit tougher, but that's why the interest rates and terms are a little better. And then always ask if your buyer is a veteran because they can get 100% financing. Non-owner occupied, if you have 4 homes or less financed, then typically you can go up to 75% loan to value in today's marketplace. You can potentially go up to 80, but then the pricing hits get a little drastic. And then when we speak of a single family or multi-units, once you hit that magic number of 4 houses financed, which is your primary home plus 3, now your max loan to value is 70%. So you need to know that going in. You're going to need more down payment money if that's the route you're going to take. And then no matter how many homes you have financed, if it's a 2 to 4 unit, it's going to typically be a 70% maximum loan to value on a property. So 2 to 4 units have higher interest rates. You need to have more money down or more equity into the property. It makes it a little bit tougher. And also the same rule applies on a single family. If you've reached that magical number of 4 homes financed and you're going on to the 5th one, then it becomes more difficult from a loan to value perspective and qualification perspective. So to kind of tie a bow on our training tonight, hopefully you've taken some good notes. Glad the UD team invited myself and Kevin here from Palliser and Shea Funding here to help you guys out. Again, we have thousands of investor trainings, thousands of blueprints put together so that you move forward and you don't make the mistakes and you close on deals, and then build the best investment team. And our overall goal for you is once you know some of these rules and you don't make these mistakes is that you can invest with confidence. And if you need help from us, obviously you see on the screen here, if you want to apply or have your purchasers apply so that we can tell you immediately as your teammates whether or not the person's good, and you can move on to your next deal and have Keith and Terry find you the next property to write a contract on, then go to applywithkevin.com, or you can simply email Kevin with any questions you have with funding or hard money, you name it. There's his phone number. And then as a bonus, we have a 22-question checklist that we go through with investors. If you go to www.getmyblueprintanswers.com, we'll give you the answers to those 22 questions so that you guys don't make mistakes. And the bottom line here is that we're here tonight to help you train, or if you're watching it on YouTube, we're committed to helping you close and do it the right way so that you don't run into problems and cost yourself more money, or simply cost yourself a deal, or cause yourself to pay more money because you have to hold on to a property and find a new buyer. Bottom line is that prepared investors win, and hopefully you take a lot as a CEO of your business away from tonight's training, and go out there and write good contracts that close and create some wealth through real estate. So Keith, Terry, hey, appreciate it. For myself and Kevin, we appreciate you being here. We hopefully made you a smarter, sharper investor, and enjoy your evening. But again, thanks, Keith and Terry.
Hey, we want to really thank you guys for taking the time to present with us tonight. That was Definitely awesome information. And again, if anybody has questions about mortgages or how to set up a good plan, you can always contact Jason or Kevin on the contact information you see on the screen. Just want to mention one more time that this presentation is being recorded. You can replay it on YouTube. Go to UD Team on YouTube, and you can also find it on iTunes. Just search out UD Team. So again, thanks for everybody that took the time to listen to us tonight. We're going to have some more webinars and podcasts upcoming, so take a look for that. And everybody out there, have a great night.
Thanks, everybody.
Talk to everybody soon. Thanks. See you.